Okay, Philip, do we want to make a start?
Okay, there we go. Can you hear me okay? Good. Well, welcome everybody this morning, bright and early start. The webinar today is we're discussing different aspects of the economy, particularly the spatial economy, in the context of the current crisis. So building on the work of the Productivity Insights Network, where we have examined a great deal of different aspects of the productivity puzzles facing the United Kingdom in the context of international evidence as well. Building on that, our team are, as you can see, many different institutions across the UK. And what we're doing now is we're moving on from our previous book, which was Productivity Perspectives, which has already been very, very widely taken up in the academic arena and also in the policy arena. We've just announced the publication of our new book that was published a week ago. It's called Productivity Perspectives. I have my copy here. It's just been published by Edward Elgar, both in hardback and in paperback from the outset, which is very unusual. So we're delighted and very grateful to the publisher for backing our project. It's a 300-page book. It's very, very detailed. There are 21 chapters written by some 43 authors, co-authors, and it's looking at the effects of the crisis that we're going through at the moment, the likely medium and long-term effects on our economies, with a particular focus on the UK, but drawing evidence from many, many different parts of the world and many different fields of literature. So today what we're going to have is three presentations by Ben Gardner from Cambridge Econometrics, from Rob Huggins from Cardiff University, and myself, Philip McCann, talking about specific aspects of these issues and challenges as they have been discussed in the book, but also involving thoughts and ideas that we've been working on actually since the book itself was put together, which was more or less late summer, early autumn in 2020. So we encourage you to have a look at the book. I say it's available from Edward Elgar at the moment. You'll see a lot of our work in terms of, if you go to our website, the book is posted, the details of the book are posted on our website. You can find information. We've got some wonderful reviews of the book in already from the Director General of the CBI, from Sir Paul Collier. So we're very excited, and also we feel it's not just the ideas and the issues we raise, but of course also the timeliness is extremely important. So I would suggest without further ado, we'll move straight on to the first presentation. Ben Gardner is one of the co-Is of our Productivity Insights Network. He's one of the chief economists at Cambridge Econometrics, done a great deal of work with, particularly with Ron Martin, Peter Sunley. There's a team at Cambridge, Southampton that Ben's done a lot of work with, really uncovering in very detailed micro data a lot of the dynamics of the UK productivity puzzle, particularly as it relates to geography and regions. So Ben, I'll hand over to you at this moment.
Thanks very much, Phil, for the big introduction. That's most appreciated, and thanks more widely to the PIN Network for putting this event on today to talk about our work within the book. So our work is chapter on sectoral and spatial impacts of the most recent recession. It starts with an apology to Tolstoy, really, looking at how the recovery periods and boom periods are often very similar when you look at economies, but it's the recessions and the downturns that are often quite different, usually in their cause, and then at least in the start of how they manifest themselves. And I think the current recession that we're in is certainly no exception, given the kind of rapidity with the lockdown of certain sectors, certain occupations, massively affected the changing way of life with travel patterns, use of cities. And what we look at in the chapter is kind of what we can learn from previous downturns. And certainly it's that the causes of the downturns are all often quite different. The initial shocks as they go through sectors and regions and local areas are all also quite different. But then as things evolve, they do start to share certain commonalities in terms of how Discretionary spending amongst consumers starts falling as saving goes up with the uncertainty. Similarly, on business side, profits going down, investments going down. And also the strong kind of cyclical effects that you observe on productivity time and time again when you look across the recessions that have happened in the past. And what I'm going to do here is just do a quick update really on the position that we were in last summer as we reported in the chapter with the data we had, looking to see what more we know, and also looking forward, given other things happening with the UK economy at the moment, the future prospects. So if you have the next slide, please. So this chart basically takes labor productivity and across time. So if you imagine at the beginning, you've got a very long quarterly time series from the 1970s through to the latest quarter 3, I think it is, of 2020. And what I'm doing here is I'm splitting that time series up into chunks. Each section starts at the peak of productivity before the recession and negative growth sets in. So you take those different sections and then you index them to start at 100, so you can compare how each recession evolves as it moves forward in terms of productivity. And this is taken from the latest ONS release of data. And what you kind of observe when you do this across all the different recessions and the quarters that how productivity evolves is that there's always typically a downturn in productivity to start with for the first year or so, first 4 or 5 quarters, because employment takes time to adjust compared to output. So output is the first thing affected in a recession, with firms produce less, and then they start adjusting their labor workforce. This has happened when you look at the red dotted line, which is the equivalent figure for the current recession, in the extreme. And the reason it's happened in the extreme is because of the furlough scheme, namely that output has adjusted in the normal way that it does, but employment hasn't, because people are still being kept on. But if you compare that against the green dotted line, which is the hours worked figure, you can see that that has adjusted much more in line with what's happened previously. And the reason is hours worked has adjusted because it's not affected in the same way as employment is for the furlough schemes. I mean, there's a little bit of a blip there in the last quarter and what it's doing, but generally speaking, it's the data we observe at the moment is a slight function of the kind of institutions and the situations being imposed on the labor market. So it's hard to know exactly what to read into this, and what we really understand from these kind of data. But what you can see certainly is the most recent recession from the Great Recession from 2008 onwards, the slow kind of recovery in productivity compared to previous recessions, which is the productivity puzzle effectively. And the big question is, what will productivity do once we add in a few more quarters or a few more years? Will it bounce back? Will it settle down to a low growth or whatever? And they'll come onto this in a minute or two. The next slide kind of looks at the regional picture as much as we can say things. And now, again, taken from the latest ONS release in conjunction, I believe, with the Center for Economic Statistics, and it presents a very nice tool for looking not at productivity, unfortunately, this time. They just focus on output or GDP growth, but you can compare what's going on latest quarter across regions and sectors. And in a nutshell, what we're observing is that there's a very, very similar profile across each region. The same sectors are being hit across every region. And the maps, I've just put a couple in there, but whatever ones you choose are all fairly boring, in the sense that there's not much color variation, because there are a lot of common shocks. but we have to realize here that we're talking about large regions. And so you will get a commonality of shock. Typically what we find in our research and is in the chapters, the further down the geographical scale you go to smaller regions, to local areas, the more heterogeneity you get, the more variation of results. But unfortunately, the kind of official data like this aren't out for those areas yet, so we won't see that. But there's been good work by Centre for Cities, Centre for Towns, others who have looked into this evidence as to how different areas are faring and why that is. If we move on to slide 4, this kind of reinforces the picture. It's the overall first couple of quarters of last year as to how the different regions are doing. And again, you can see, I mean, yes, there's a little bit of variation, but by and large, they're all within 5 percentage points of each other. So there's not that kind of large amount of variation that people might necessarily expect. And when we come to talking about things like left behind places, which is becoming a little bit of a cliche in a way, it's clear that these are much, when you're looking at how individual places will fare as a result of the current recession, there's a whole lot more characteristics that go well below the regional level to do with whether they're coastal versus inland, industrial, non-industrial, towns versus cities, that makes up what we will ultimately observe when we come to look at how places have fared coming out of this in the coming quarters and years. So next final slide, really, just to look forward, because I believe that there's only so much you can gain by looking at the current data, because it is quite messy and affected by what's been imposed on the different systems. But so the short run effects we can see largely kind of manifestation of the sector shocks with a bit of variation around the side. But as to the longer run, that's the bigger question. As I say, where does this red line or the green line go after another year on, 5 years on? Do we see this sustained bounce back, or do we see another continuation? Do we see another puzzle of how things are going? And to my mind, it's really a question of what are the basic drivers of productivity? What are the interrelations going on? And we know these. We know it's skilled labor and human capital. We know it's physical investment and capital stock, access to financial capital, agglomeration with its urbanization and localization effects, innovation. These are all still around. These are all still happening. But the bigger question is whether the Covid-19, the pandemic and the effects of it have permanently affected the strength of these drivers, or even have they affected the transmission mechanisms through which these drivers affect productivity and general growth of local areas and regions. And I think it's a kind of two-way thing here, because and each of these kind of drivers I mentioned, you could devote a whole webinar to, and people have devoted whole webinars to. I mean, if you take the agglomeration and cities argument, cities are having a bit of a hard time of it at the moment, given the density of their populations and the transmission mechanisms of COVID that feeds off. So are the agglomeration effects weaker, and will they be permanently weaker with the kind of the skilled labor, human capital aspect that feeds off that, or with teleworking, are cities becoming less important, and people are able to work from home? At least some people are further away, so this effect is a bit lessened. So I think there are kind of pluses and minuses on either side, but our own feeling looking forward when we're doing our kind of forecast for Cambridge Econometrics of regions and cities in the coming year is that the general prospects are probably not so good, in terms of the negatives will generally outweigh the positives. The other thing to note is that what we've observed so far in 2020 and will do for the couple more quarters are largely the COVID-related effects. As soon as we get into observing what we see in 2021, everything is going to be confounded with Brexit and the shocks to supply chains, added uncertainty on investment that this is already bringing about, as we know. So our ultimate view is that the prospects for productivity growth are not too rosy at the moment and won't be going forward. We don't expect a huge rebound. How this manifests into the spatial divergences we've observed and the widening of gaps over the last decades. My view is that we may even come to a point where spatial gaps narrow, but I think that will only probably happen through leveling down rather than leveling up. So on that optimistic note, I'll hand back probably to Rob to take things forward.
Okay, I'll kick off. Building it really upon what Ben was saying, I'm going to concentrate looking at cities and a particular aspect within maybe change around COVID with regard to innovation. If we can move on to the next slide, Kat. This is work with my colleague Piers Thompson at Nottingham Business School. And I guess we're addressing three questions within the chapter. How is the nature of innovation changing, especially within and across cities? What role is the pandemic likely to play? And then what are going to be some of the challenges relating to productivity? And the chapter is building on some work that we were already undertaking prior to the book and prior to COVID in a way. And we'd undertaken more than 100 interviews within 6 cities. We're looking at particularly big cities. We're trying to understand what was happening in big cities as a way of trying to think about where maybe smaller cities, second-tier cities can actually develop and grow with regard to innovation. And we took about, I think it's about 120 interviews. We looked at London, Berlin, New York, Los Angeles, Tokyo, and Shanghai. So we were trying to look globally and see if there were differences and some commonalities. So we're using some of the lessons from that, what we found from the interview, so maybe to give some insights, possibly in terms of what might happen as a result of the pandemic. And we think some of these trends had already started and maybe they're going to be accelerated as a result of COVID. But again, some of this is conjectured away. Next slide, please. And I started, when we started preparing the chapter, I was reading this book by a chap called Hilton Root. I think he's a political scientist at George Mason University. And he was arguing about the changes in the network structure across the global economy. And this second quote at the bottom, he says, a multipolar world is emerging that is vulnerable to unexpected shocks from any corner, which sort of hit me with regards to COVID. But I think he was talking more about political and economic shocks at this point in time, rather than sort of shocks leading from health. But I guess it was good timing for it to some extent when he published his book. But again, it sort of, I think, sets the sort of the scene in a way for thinking about some of these changes. Next slide, please. This goes back to some of the press that came out, the media press in the immediate aftermath, I think, in terms of COVID. Some piece from John Gray saying that the era of peak globalization is over, blah, blah, blah. We're at a big turning point in terms of history. And this says, this is reflected in 2 ways, really. Next slide, please. In terms of thinking about globalization, but also thinking about the role of cities, which Ben touched upon. There's been quite a lot of press, and there's continual press at this point in time of saying maybe, possibly it's the end of cities in some ways, or the end of the agglomeration effect and some of these positive externalities. And a lot of this has come out from the US. And there certainly is some changes, I think, in terms of the way that innovation is being arranged within the US, which is probably going to be reflected elsewhere. But how far will it go? And is it really the end of cities? Which I think is what we're trying to question with regards to innovation in this chapter. So next slide, please. And of course, this is quite a change really from a lot of the literature, particularly a lot of the academic literature, which sort of eulogizes cities in many ways. We go back to sort of Florida, was it 2000, 2002, the rise of the creative class, the way we see the value in terms of amenities within cities. Glazer trying to bring it all together in a way, and thinking about why maybe growth and innovation will continue to be concentrated within cities. And there's a relatively new book from Sharon Zukin, the book, the Innovation Complex. She's more critical in a way of cities and the way that cities have developed. This is a case study of her own city of New York. And it's a nice book. And she talks about the way that New York is very accelerated really after the 2008 crisis, of becoming a center for tech in a way, because she argues that it's not all good in a way, and thinking about inequality within the city, and how that's, again, some of the negative aspects in a way. And again, to be fair to Florida, he's built on some of that in more recent work as well, thinking about the urban crisis. And then myself, and next slide, please. And thinking about, well, why are these cities important? And they're obviously for numerous reasons, but particularly with regard to innovation. I was reading this book by Safi Bakar and Loonshoots. And this builds on another literature really, which talks about the role of density, and saying that particularly if you need innovation, you need radical innovation, you need density of people, and density of the networks, etc., and thinking about the links. So maybe we see this correlation between density and innovation and the need for urban agglomerations, I guess. Next slide, please. And then myself and my colleague, Piers Thompson, we're trying to think about this from a behavioral perspective. And this is a gratuitous sort of plug for our new book, which has just come out. So maybe we can plug more than one book today, maybe, where we've been trying to think about the way human behavior and different patterns of human behavior concentrate in particular places. And one of the things we look at in terms of thinking about how the positive lock-end regions emerge compared to sort of negative lagging regions. In a way, we look at the role of agency and the ability to change and adapt. We look at culture, psychology, and again, whether there's a diversity within particular places. And then the role of institutions, obviously, in terms of whether they're wealth creating or maybe more rent seeking. And I guess even though it's not totally binary, you can see them within a lot of the cities, at least leading cities, they possess some of these behavioral traits that are more leading towards positive lock-in and allowing, a more path creation in terms of their growth in the future. So that sort of sets the scene. Next slide, please. If we go all the way back and thinking about the role of cities with regards to innovation, you go back to Jane Jacobs' book, I think 1969, The Economy of Cities, and she's trying to sort of reflect on that cities are actually very inefficient in a way. She says they are inefficient. Lots of people maybe not doing everything in the most optimal way, but she says really this inefficiency is the value of, and this actually comes from a case study. She was looking at Bristol, at Birmingham, in the UK, and she really sees the way that developed at certain points in time because of the networks that developed in a way, and the density and the sort of the chaos allowed certain innovations to emerge there, which sort of takes us towards thinking about some issues around complexity in a way. Next slide, please. So what we do within the chapter, we use some of these 100 interviews that we've done. We do an initial analysis. We're trying to do a deeper analysis of those to think about what was already, what we found was changing, particularly within these big cities, and how this may actually, what trajectory may continue, as I say, or accelerate with regard to innovation in the city as a result of the pandemic. And what we argue is that there was already maybe quite profound changes are emerging with regard to innovation, especially with the way that we see growing patterns of open innovation, and particularly the way that we know that larger companies are outsourcing more to entrepreneurs, smaller firms, etc. And we sort of argue that they pass the burden of innovation from being the bigger corporations to the smaller, less resourced well, to the smaller, less resourced entrepreneurs. And we examined a number of these links, and we found often that there was not a lot of benefit in terms of outputs, high levels of what we might call failure, in terms of thinking about more commercialized products that were actually going to have an impact in terms of the development of the city. So again, some quite, as we would argue, profound changes there. Clearly, we would say if any city is going to work, it's going to need quite a dense. We agree with Bakar. A skeletal network architecture for innovation is not going to be effective in most cities. There does need to be this density, these thick networks in a way. But we think that there are changes in the way that cities are set up, between the relationship between some of the larger cities and some of the smaller ones. And we've seen this within some of our case study cities. Next slide, please. And what we would argue is what we were finding is yes, you've got the big innovation hub city, but there's a change for a number of forces, the continued search for new ideas and knowledge. Obviously, the hubs are going to be attractive in terms of agglomeration, we think, and amenity forces, but there's some of these behavioral aspects and negative externalities which maybe push certain people and firms into more innovation satellite cities. And we certainly found it with thinking, we looked, one of our cities was Berlin, and we could see that Berlin had sort of grown quite rapidly in terms of sort of a creative, innovative hub. But other cities around it, Potsdam, Dresden, Leipzig were growing as well. And there was strong relationships between those cities. We could see it as well within the US. We didn't look at Silicon Valley. We looked at the way that strong relationships were developing between Silicon Valley, maybe Los Angeles. And we can see now quite a change in terms of second-tier cities coming forward as centers for innovation. Been quite a lot of press recently around places like Austin, Texas, with remote workers moving to Texas more, often because there's cheaper taxes, and a number of leading tech firms at least having outpost sites within those cities, or even moving their HQs there in a way. And the same maybe within some of the other cities within Europe and Asia. So we think there is a change in pattern. Whether it'll be sustained, well, at the moment we can see, particularly say for New York has lost quite a lot of tech employment, of people have moved to other states, mainly for tax reasons. Obviously, we haven't got the same sort of forces in play within the UK, but obviously there's other issues in terms of behavior, in terms of costs, etc. So we think this pattern will probably accelerate, and will lead to maybe different hubs and different satellites growing and contracting over time. Final slide. Next slide. Yep. We conclude when it comes down to it, thinking about this idea of inefficiency, and you don't often see the returns from innovation that you may expect within many cities. We sort of argue it's a network phenomenon, and that's really we argue that we're talking about complex adaptive systems in a way, and the outcomes from that are very non-linear, so it's difficult to predict. And we think a better understanding this idea around non-linearity will sort of maybe explain some of these issues around the productivity paradox, at least within the context of innovation. And Henry Chesbrough saying some similar things around this at the same point in time. So if you take this value of efficiency idea, important, I think it can have but we should start to think about how do we apply this to public policy, which again, public policy is very linked around sort of a causal logic in a way, where we know some of the literature is now pointing us in terms of entrepreneurship and innovation is around issues around effectuation in a way, and trying to build on the best resources that you have. Some of this goes back to ideas around smart specialization. So finally, we conclude that we think in terms of the pandemic, we can look at some of these changes that are happening within cities and across cities from this behavioral lens, and thinking about changes in preferences, tastes and values of individuals and firms as well. So I'll leave it there. Thanks very much.
Thanks very much, Rob. I should say I was not able to give Rob an introduction. I gave Ben an introduction. I also just Rob's done some great work on particularly this link between cities and innovation, as you can see from his newly published book with Oxford University Press, and Rob's kind of led on those themes. He's been theme leader on these areas for the Productivity Insights Network. So hopefully this work will continue and also dovetail with the work of other co-Is. And then also many of us are linking in now to the new Productivity Institute, which is headed by the Alliance Business School at University of Manchester. I see that Bart Van Ark, who's the head of the institute, on the meeting this morning. Welcome, Bart. So, you know, these issues are not going to go away. All the issues that have been highlighted by Ben and Rob so far, they're not going to go away, but they will increase in importance, and also they'll change in different ways, as been indicated. And so the nature of the pandemic, you know, some people have said it's going to kind of turn things around. We're going to change the nature of things. Larry Summers says his view is it probably will exacerbate pre-existing trends. So that's what I'm going to talk about here today, which is based on the chapter, new slide please, Kat. The chapter I've co-authored with Professor Raquel Ortega-Arquiles at the University of Birmingham. And in our book, what we're doing is we're trying to articulate arguments about the likely trajectory of what will happen, particularly in terms of the spatial geographical dimensions, on the basis of international evidence as well as UK specific evidence. So if we can go straight on to the next slide, please, Kat. Next one again. One way to think about this, and of course there's lots of different ways, various members of the Productivity Insights Network, myself, Jen Nellis, Tim Worley, we were in a webinar yesterday with the OECD, and one of the sessions was chaired by Lord Jim O'Neill, who you know is the chair of our International Advisory Board. And we had very, very interesting discussions about these kind of outcomes. They're difficult to predict, but we're trying to follow through a set of principles. So one way of thinking about it is to think about the difference between the leading firms and the lagging firms. You know, this problem of the long tail that Andy Haldane has raised. There are discussions about whether the effects of the crisis are really going to be primarily on the long tail of low productivity firms, or will those shocks also be, in some sense, on some of the more productive firms? Now that may sound a strange assertion. You immediately think, well, the more productive firms will be more resilient and will come out of this much better. But what we know from the previous crisis in the UK, that's not what happened. The shocks in terms of the global financial crisis were primarily on the more productive firms that were outside of the core of the economy in London and the Southeast. So the more productive firms in places like Manchester, Liverpool, Newcastle were actually hit much harder than the less productive firms in those same regions, or the less productive or more productive firms in the more prosperous regions. This is a really curious observation. And if we think about the effects of Brexit also tied up with coronavirus, it's possible that we might see some of these types of shocks again. We don't know. But the point is to think about these outcomes are, you know, they're not going to be easily predictable. And certainly the evidence from the previous crisis is that many of them were apparently counterintuitive, but at the same time very profound. Part of these things will depend on where organizations, firms are positioned in global value chains. You know, the collapse of international demand, the shocks to supply chains are forcing a lot of supply chain reorganizations. What we're seeing is adoption of new technologies, firms reconfiguring supply chains and so on. We know that there have been profound shocks to certain sectors, hospitality, travel, tourism, automotive, for example, high street retail. We know that they're very much in the center, in the eye of the storm at the moment. The question is what will happen in the medium and the long term. And the other area, which at the moment, of course, is right in the eye of the storm, are the skills-related markets, the job markets for graduates, university graduates, school leavers. Many of those markets have to all extents and purposes dried up completely. And actually a new report that came out from The Economist, I think it was a couple of days ago, said also the job market for over 50s. So those who lose their job over the age of 50 are finding it almost impossible to find new work at the moment. If we can move on to the next slide, please. But what are the key features? Well, one of the things we know is that the relationship between central government and local or subnational government has been permanently shifted, or at least for into the medium term, maybe the long term, because governments have had to intervene in every country and have, in a sense, taken over ownership of key parts of the country. The whole furlough schemes, which are being operated in most industrialized societies, de facto, what's happened is the government has intervened and taken over what in the old language used to be known as the commanding height of the economy. In effect, that's what's happened, and on a scale that we haven't seen since wartime. So that will shift the balance between fiscal and financial positions of central versus subnational government. There will be fiscal retrenchment, there's no question. The question is, what's the speed of it? We don't know. I mean, there are kind of certain groups who are advocating rapid cuts in public expenditure to try and move back to something like a more normal debt and deficit position. Other people are saying, no, interest rates are extraordinarily low. You've got to take a very, very slow adjustment out of this. That's one side of the discussion. The other side of the discussion, of course, is we also don't know what is the willingness of markets to lend to governments in this kind of unknown context for which there's no precedent. If you look at a lot of the literature, there's a lot of confidence at the moment in the bond markets, but there's also a lot of volatility in these markets. And the reason is that investors are not quite clear how things are going to work out. In terms of the productivity debate, and particularly that relate to regions, an important element is this core periphery structure. And Andy Haldane's description of the UK economy is an economy which is a hub with no spokes, I think is a very good one. And you can think of that both in terms of between the leading firms and the lagging firms, that gap between the frontier and those behind the frontier within sectors, and also between sectors, and also in the UK, more than pretty much any other country, also between regions. Why is this? If you think in terms of R&D, the UK tends to be pretty good at R. We've seen that with the vaccine developments, for example, outstanding in terms of R. And if you look at Nobel Prizes, academic prizes, and so on, university citations, R is clearly where the UK is extraordinarily strong. But the D, and we tend to think of it in research and development, but as Andy Haldane talks about, development, D is really about development, dissemination, diffusion, the 3 Ds. These are areas where we just don't seem to be good at that. They're not our competence, in the sense if you compare ourselves to countries like smaller countries like New Zealand, or medium-sized countries like the Netherlands or Sweden, versus large countries like Japan or Germany. They're the areas we seem to be weaker on. And one way of thinking about it is the knowledge economy, the idea that we're moving to an economy of much more intangibles, intangible assets, and that changes the nature of these kind of development, dissemination, and diffusion dynamics. And then Jonathan Haskell and Stephen Westlake's book, they talk about the economy as being characterized by 4 S's, the intangible economy: sunk costs, scalable dynamics, which also build on and rely on synergies and spillovers. Now, sunk costs and scalable dynamics tend to lead to concentration, both in markets. We see this in terms of the big tech firms, kind of monopoly and monopsony type positions. And this is also true geographically. There's a lot of evidence on this. At the same time, the building of synergies and the generation of spillovers could go either way. You could have synergies and spillovers that lead to widespread geographical diffusion, the Canada phenomenon, or the Australia or Japan or Germany again. Whereas the synergies and spillovers can lead to concentration and greater inequality. We've seen this certainly within individual city regions in the US, the kind of hinterlands, so-called heartland being drained, and the cities gathering up a lot of those innovation dynamics, as Rob has just been explaining. Or in the UK case, this extraordinarily concentrated knowledge domains in certain places. Is the crisis going to change these things? Well, one argument, of course, is that teleworking, we're all kind of living in this Zoom economy type environment now, has been a huge natural experiment. And what that's going to do is going to potentially reshape diffusion processes, because people will be able to work more efficiently online. That suggests more of a convergence process, because people can shift away from core areas. That's one argument. But there are arguments to say absolutely the opposite may happen. I'll come back to this in a second. Other areas are things like in terms of venture capital, evidence from banking. In some sense, the use of IT is actually making some of those markets more efficient. there's actually more applications going through, but also much faster rejections. The difficulty is a lot of these rejections are based on increasingly automated systems, which tend to be much less discriminatory. So the kind of long-term relationships that will characterize banking systems in places like Germany, Sweden, for example, long-term relationships between financiers and investors and entrepreneurs. You'd see this also in countries like Switzerland, or the community banking arena within the US. This would work against that. So that potentially leads to more centralization. Next slide, please. So what have we come through? Well, we started off in the ordinary context, of course, late 2019. We were still in the ordinary economy where investors are apportioning probabilities and risk profiles to different assets, different entrepreneurial ventures. We suddenly get shocked into an extraordinary situation where it becomes almost impossible to price things. And then we're trying to move back to a so-called new normal, where investors can start, those animal spirits can start driving how investors look at the world. But the difficulty is that investors' perceptions are very weakly grounded. Their expectations are very weakly grounded. You know, we have people saying we're going to have a V-shaped kind of response. The Bank of England in the UK is very optimistic at the moment. Other people, it's more of a Nike swoosh stripe type shape. We've had Z-shaped, W-shaped, U-shaped, L-shaped. There's even the K-shape, which is the partitioning of different parts of the economy, some coming out of the crisis very strongly, other parts of the economy basically going backwards, all of these things. This reflects the fact that investors don't know, because there's no real precedent for this. And you see this also in terms of the volatility of movements, not just the markets as a whole, but between asset classes and within asset classes. Prices are going up and down, really all over the place in many markets. What we do know is the scale of scarring depends on the time to develop the vaccine and roll it out. And it's this point about R&D. It's not just research, it's the development, and development is broken up into 3 Ds: development, diffusion, dissemination. And it's exactly the same principle. If we can move on, please. And of course, that's not just about the UK. Our ability to move forward also depends on the countries around us and the countries where we have the most interactions in terms of movements of people, goods and services, also being able to successfully deploy those vaccines at speed and scale. There are arguments that it's going to lead to reconfiguration a little bit of trade relationships, some sort of more localization, nearshoring, reshoring. The problem with that way of thinking, there may be some of that around things like 3D printing, artificial intelligence, and so on, automation of certain new types of technology. The difficulty is that the ability to do that already depends on the existing global value chains that we're part of. If you're not already in a certain technological space, it's very hard just to invent it. You know, I think there's a lot of optimism in certain areas about this, which I'm not sure is particularly well grounded. And of course, the leading firms we know are better integrated. And if you look at the work of people like Richard Baldwin, his argument is being better integrated in global value chains also provides tremendously foundations in terms of resilience, because you're much more able to shift your assets and knowledge networks and build on what's happening elsewhere. The less integrated you are in global value chains, this becomes much more difficult. Next slide, please. So looking at the kind of movement in terms of what's happened recently, this movement from normal to the risk environment is really the kind of difference between risk and uncertainty, the distinction between Keynes and Knight, which is almost exactly 100 years old, Knight's article. And one of the things that we know from the previous global financial crisis is what happened was that the shocks to the financial system, which basically a result of profound radical uncertainty, which is the situation that we're in now, what it did was it massively widened the yield spreads between asset classes and within asset classes. And this led to enormous capital reallocation shocks between places. So within asset classes and between asset classes, but what we know now is it also led to massive capital allocation shocks between places, favoring certain types of places and discriminating heavily against others. We see this geographically as well as sectorally and across different asset groups. We know that there'll be some winners. Private equity, many areas of the private equity arena have in a sense, gained a great deal in terms of what's happened in terms of the crisis. So have a lot of the big tech firms. But in general, most people are going to lose. We know that. And this will also be allied with greater movements towards concentration and monopoly positions, because a lot of firms will basically lose access to finance. Next slide, please. And I think here the two areas I'm most concerned about are the SME economy, particularly the entrepreneurial SMEs, those kind of local entrepreneurial ecosystems that really underpin local economies. They're going to be extremely vulnerable. SMEs are being squeezed from two different sides up and down at the same time. The general withdrawal of capital in many markets will squeeze SMEs from the bottom, but from the top they're being squeezed by a lot of formerly investment grade large companies which have now been downgraded to effectively junk bond status, and therefore are not able to access capital through the normal money market mechanisms that they would do, and they're having to shift much more to bank finance, where de jure they have unlimited credit, de facto they never use it, but now they have to. And one of the things that we know is SMEs, not only will they get squeezed, but what we know from the previous crisis is it was the most innovative SMEs that got moved to the back of the queue, because as we come out of a shock, banks understand what cafes do, they understand what hairdressers do, but if you've got young entrepreneurs with a techie idea, it's much more difficult to understand, and the banks at the moment don't have the resources or the time to screen all of these issues. And also, as we move to much more artificial intelligence-based screening, these will tend to move away from the more innovative SMEs. The other area I would be particularly concerned about is the real estate markets, particularly in the weaker parts of the UK, where cities are trying to rebuild and turn around. Real estate is very illiquid. It's medium and long term by definition. The availability of medium and long term capital is now reduced significantly, and it's the difficulty of the inability to value assets. When the economies are going through these shocks, there are weakly grounded expectations. It's much more difficult to do anything. To price anything in terms of the medium and long term. So my guess is that yields are likely to rise in many of the more risky places, the weaker places and the smaller places in the UK, particularly the weaker cities. And they're likely, if anything, to stay low and lower even further in the more prosperous places as we move out. That would be my guess. Next slide, please. And this was basically what happened in the previous global financial crisis. So my guess is that the major shocks are going to favor the more prosperous places, relatively favor, not in absolute terms, but relatively favor the more prosperous places and move against the weaker places. That would be my general guess as to what's going to happen. Just to move on to the last slide very quickly. Next slide, please. Just thinking about all the leveling up discussions now, which is obviously everywhere in terms of policy thinking and politics, the combination of Covid-19 and Brexit. Brexit will almost certainly move against leveling up, because the parts of the UK which are economically weaker are relatively much more dependent on European markets. This is ironic, of course, but this, I think, is the reality. And in terms of the capital shock arguments I've just outlined here, my guess is the two of them will complement each other to work against leveling up. So what does that tell us? Well, at least in the productivity issue, that we have to take the leveling up arguments even more seriously than might previously have been the case. I think scale matters. If you're going to devolve, you've got to devolve in a large scale. At the moment, everything's very fragmented and too small in the UK by OECD standards. We also need to think kind of interregional fiscal stabilizers, and particularly if you're going to devolve, which in the medium and the long term would allow localities to think about going to capital markets independently, for example. So I think the situation at the moment is very fragile, and there's a lot more to be discussed in this space. So I will stop there, and I would suggest we bring both Rob and Ben back into the conversation at this point. So we've got a few questions here. So looking in the chat box, Rob, if you question, will changes to cities impact on the plans for towns that pin their development in terms of connectivity to cities? Will there be further disadvantage, do you think? Do you think it will change how we think about this, Rob? Would you be interested in picking up on that one?
It might change how we think about it, but I'm not sure. I think in the long term, it's still, it's still a good thing to develop these relationships between the smaller towns and the larger cities. Just thinking back to where I am now, just outside of Cardiff, again, which is different from thinking about a very, very big city. I fail to think that over the long term that there's going to be a downside for some of the smaller cities around the periphery. There'll be changing dynamics. I think that the cities will remain as the hub in a way, and I think the smaller cities around it can benefit, and they need to work together. I think that's the crucial aspect in a way. If it's going to be a city region or a wider polycentric configuration, they really need to have strong connectivity. I think there's still too much competition. I was mentioning it in an earlier question that I had that I answered on the text. When I was in Berlin, I saw really strong relationships between what was happening in Berlin and some of those the cities around on the spikes, around the Dresden, the Leipzigs, and the Potsdam. Very strong relationships between the government, between the firms as well. And I think that's what we can learn lessons from what's happening within other cities of Europe. I think we can do it from the Netherlands as well, numerous other Nordic cities and city regions. I think we haven't quite got that right yet.
What do you think, Rob, in terms of those towns which are not in city regions, for example? They're outside. So you have a city region construct such as Greater Manchester, for example, but you've got places like Blackburn, Blackpool, which are simply not part of it. What do you think would be the situation for places like that? Or, I know in South Wales, you've got the same thing with the Cardiff city region. Those places which are outside of that, what do you think is the best approach?
I really do think that the only approach is to improve the connectivity. I think in terms of hard infrastructure, but thinking more about links between where businesses move, and we would try to make those places more attractive in a way. There's no silver bullet. I think it's about the connectivity and improving the attractiveness and making sure that those towns have some kind of sell. Not everyone wants to be within the large city in a way. They may want to be in the larger city down the line as the business grows or the individual develops. But I think there's tiered roles, but it needs coordination.
Yeah.
If I just link into that briefly, there's another question from Annette Bramley on the work that we did with Tim Vorley on the TFN R&I landscape. And I think just understanding more clearly how places link together through their innovation networks, their R&I networks, by looking at things like the patenting data, who cooperates with who, how they cooperate. It just adds another piece in the jigsaw of how we understand cities and towns and places relate to each other. And if we don't do that, we risk just ignoring these connections and blindly going along with policy that we think might work, but don't understand the actual underlying mechanisms that support it. On top of that, I think, I echo what you said, I think we need a lot more cooperation across towns and cities, and a lot less competition, in the sense that people are competing for a pot of funds rather than actually thinking about how everyone can contribute together. Yeah,
I agree. A couple of thoughts. One of them are in terms of the low carbon economy. When I was in this OECD meeting yesterday, one of the points I made is that, the next few years, governments are going to be just simply focused on getting people back in work, getting businesses solvent again, getting as many people off the unemployment registers. Once the furlough schemes are withdrawn, the shocks are likely to be very, very serious in every country, and governments are going to want to get those countries back on track as quickly as possible. The risk there is that the kind of build back better type of slogan actually is basically ignored. It's just saying, well, we'll do that, but we'll do that in a few years' time. What we're going to focus on is simply getting businesses and people back in work. So, and I know that even the Secretary General of the United Nations has made a statement on this, basically concerned that we're going to lose 3, 4, 5 years off the Paris Accord agreements, because it's going to take that kind of time period for governments to feel that they're back in a situation where they can start focusing on the kind of the climate change mitigation agenda again. That it's basically going to be, whatever the language, de facto it'll go on the back burner for several years in most countries. That's a real fear. Another observation I have, and this really comes out with talking with Tony Venables, One of the arguments about teleworking is that people will have to go into the office in the city centre, for example. Instead of 5 days a week, you're going in 4 or 3 or 2 days a week. There's a new paper by Nick Bloom on this that came out recently. One of the issues is that it could change the catchment areas of cities in favour of more prosperous places. And the argument is this, that let's say I'm working I live in a small village outside Sheffield. I commute every day into Sheffield. I could apply for a job in London. Salaries have been much higher, but the idea of a 2.5-hour commute to London each way, each day, plus the transportation cost simply makes it impossible. And even trying to cross the Pennines every day with bad weather, on the train to Manchester, you kind of think twice about it. But if you only have to go into the office now once or two times a week, that's a possible agreement you can have. Then suddenly jobs in Manchester become much more interesting than a job in Sheffield, because the salaries are going to be higher. And actually a job in London becomes even more interesting than a job in Manchester, because for the same reason, now you could actually tolerate 2 trips a week to London, but double the salary or triple the salary, for example. So there is a risk that actually we'll get a kind of reordering between places on the basis of their catchment areas. And we just don't know how those impacts will work out. It could be you have a lot of people who still tend to work in the same city region, but they're commuting less frequently. So they're actually spending a lot more money locally, for example, local consumption of goods and services in more peripheral regions. That could lead to more of a kind of a leveling up type of process, and the productivity related bid rent curves will become flatter. On the other hand, the kind of this greater catchment area argument, which would certainly favour, particularly if you think about London, its very wide hinterland, going out beyond Oxfordshire, Gloucestershire, Warwickshire, and so on, that the hinterland of somewhere like London could actually increase, and therefore it would make the agglomeration matching relationships in London actually more efficient than ever, and on a bigger scale. And you may get a kind of a Krugman type shadow effect operating on different levels. So the overlapping boundaries between market areas in terms of hinterlands might actually change, and we don't know what the relative balance is of those two effects. So one is a flattening, a leveling effect, and the other one is actually a discontinuity effect that could basically mean that Manchester becomes more dominant relative to Liverpool and Sheffield, and at the same time London becomes more dominant relative to Birmingham and Manchester. These are all possibilities, and they move in the opposite directions to each other. We just don't know what the outcomes are at the moment.
Just a couple of points brief to round up, I suppose, on the low carbon economy question. I mean, work we've done with our models on the European Parliament latest kind of emission targets do show that you can still get this double dividend effect of the kind of lower emissions and actually increased employment, given the investment that has to take place in the low carbon technology. So there is a win to be had, but there will always be losers from these in some of the more traditional carbon intensive sectors. And question is where these are located and how you work around those losses and how you compensate those and
Yes.
invest in those regions to kind of offset them. Most of our work's been done at the national level, not at the regional level, where those kind of questions really become more interesting and more pertinent. And just finally on the other thing, yes, I mean, absolutely. I think the focus on the low carbon economy and more broadly other things like inclusiveness, inequality, mental health, the whole sustainability thing. If the COVID pandemic's done anything, it's refocused our attention on these equally or more important issues, as opposed to just narrowly looking at the economic productivity definition. And that's really what the PIN network is all about as well.
I think that's very pertinent, Ben. So I think we'll draw this discussion to a close. Can we go back to the slides for a moment, Kat, just to highlight about the next few weeks ahead of us. So we'll post the information about the book on the website. Of course, we said we'd do that. You can see all the information there. I guess, Robin, your new book on cities, I presume it's posted on your website at Cardiff, is it?
Yeah, and I can circulate it as well. Yeah, that'd be
Okay,
fine.
that's good.
Yep.
So next week, we have another webinar on different aspects arising from the book. We've got the next 5 weeks covered. So next week, we've got Katie Jones, Jonathan Cook, Ian Doherty. They're looking at policy implications for post-COVID-19. And as I say, the next 5 weeks going right the way through till 12th of March. And these are the next sets of webinars. And they're all based on material in the book. So different ways of thinking about how we're going to respond and come out of the crisis. And so we encourage you to kind of to check in same time next week and the week after. For the next 5 weeks, we're going to continue these discussions. And we encourage you also to discuss these issues with your colleagues, and encourage people to join these webinars to kind of share the discussion, share the ideas, and keep the debates moving forward. So I'd like to thank Kat Sloan, particularly coordinating everything behind the scenes. She's controlling all the electronics, and Kate Penny, and of course, co-director of the Productivity Insights Network, Tim Vorley. As a team, we work very, very closely together, numerous emails and text messages every day to keep things moving. And I'd like to thank in particular our co-Is, all of whom are the chapter contributors and the people who are speaking in these networks, webinars for the next few weeks. They've all done a tremendous job, and particularly today, of course, both Rob and Ben. So I thank you all very much for joining in today, and I wish everybody a nice weekend. And we'll see you next week, hopefully, same time, same place. Thanks a lot.